Okay, so investing. Remember those like easy days? You just put your money in an S&P 500 index fund and just watched it grow? Well, 2025 might be a different story. We've seen, some record gains lately, right? Almost 70% growth in the S&P 500 over the past 2 years. But analysts are saying that momentum is slowing down. Things are going to get a lot more interesting. Morgan Stanley Wealth Management, they're calling this whole thing the Great Normalization. Basically, we're heading into a market that's less predictable, more driven by how individual companies do. See when interest rates are low and valuations are high. Investors, they're more willing to pay a premium for growth, even if that growth isn't, backed by solid earnings. But as interest rates stabilize and valuations become more, reasonable, stock prices are going to depend more on how much companies are earning to actually grow. The market won't be, dominated by just a few big players anymore. Think of it this way. It's like we've been in this period of easy money, right? Almost every stock seemed to go up. But now, investors are getting more picky. They want proof that companies can actually deliver, on what they promise. This shift, a few things are driving it. One is new competition, especially in like artificial intelligence, like DeepSeek. I think they're based in China. They've developed this really powerful new AI model. Could challenge the U.S. dominance in this whole sector. This extra competition could really impact how some of these U.S. tech companies perform. Makes tech a riskier bet than it was like a few years ago. Another factor is the Federal Reserve. What they're going to do with interest rates, they've been hinting that they're going to be, cautious about cutting them any further.
Yep.
Which means borrowing costs for companies could go up, could hurt their profitability. And then there's the whole like tariff thing. Nobody knows what's going on there right now. There's a 30-day pause on tariffs for Canada and Mexico. But after that, who knows? And who knows how the market will react. Makes it tough to predict, which companies are going to come out on top and which ones are going to struggle. All this uncertainty means the market's getting riskier. Set it and forget it investing. Might not be the best idea anymore. When you invest in an index fund, you're basically betting on the overall market. But when the market gets all volatile and unpredictable, got to be smarter about your investments. So instead of like blindly putting your money in an index fund, maybe think about exploring other strategies, commodities, for example, like precious metals. Historically, they've been a good hedge against inflation. And inflation could be a problem as the economy heats up. Or you could look into hedge funds. Those are investment funds that use all sorts of strategies to make money, no matter what the market is doing. Another idea, look for undervalued stocks, companies that their stock price doesn't really reflect their true value. These hidden gems, they could really take off if you, do your homework and pick the right ones. Remember last week when the market dipped 2%, all because of those tariff announcements. Kind of a wake-up call for a lot of investors. It shows you how important it is to like really look at your investment portfolio. Make sure, how much you're invested in stocks actually lines up with how much risk you're comfortable with.
Even if you're like okay with the overall risk level, it's still a good idea to double check how diversified your investments are. Make sure you're not like too reliant on any one sector or company. Spread your investments around, you know, different asset classes. That way, if one part of the market takes a hit, you're not totally wiped out. Okay, so the market outlook. It's not all like doom and gloom. Analysts still think the S&P 500 will end the year, up. But we gotta be real about the uncertainty, these political decisions, especially about trade. They make it so hard to predict what the market's going to do. This volatility means we got to stay informed, right? Be ready to change things up, and don't be afraid to like ask some tough questions. Talk to your financial advisor regularly about your investment strategy. Make sure it still makes sense for you, for your goals, and for how much risk you can handle investing. It's not about just following the crowd. It's about making smart decisions based on your own situation and based on what the market's doing, because it's always changing. So should you get rid of all your index funds? Not necessarily.
But diversifying, more important than ever. Think about those other investment strategies we talked about and stay informed. It's like we've been on autopilot, right? Now is time to take the wheel and be a little more hands-on. This isn't about panicking. It's about realizing that things are changing, and we got to change with them if we want to stay ahead. Just like anything else, right? Being able to adapt, that's the key to success, especially when it comes to your money. So what does all this mean for you? Well, if you've been, comfortable with that set it and forget it approach to investing, might be time to rethink things a bit. The market, it's getting more, complex, more volatile. Just being passive might not be enough anymore to protect your investments and actually, reach your financial goals. Remember, knowledge is power. The more you understand about the market, how it works, what makes it move, the better you'll be at, making good decisions about your money. So stay curious, right? Keep learning, and don't be afraid to question things. Who knows? Maybe you'll even find this new market, more exciting than just riding the wave of a bull market. More rewarding, too.